Washington Mutual once stood as a beacon of financial strength. But beneath the surface, something was brewing, something even darker than the well-publicized escapades of Silicon Valley Bank. Are you ready to uncover the untold story? Before it went out of business on September 25, 2008, Washington Mutual, WAMU, with its main office in Henderson, Nevada, was the biggest savings and loan organization in the country. Nearly half of its $309 billion in assets were related to the housing sector. The housing market had burst a bubble, and as the Federal Reserve raised interest rates from 2004 to 2006 in an effort to curb inflationary pressure, the once hot housing market soon cooled. Unbelievably, WAMU increased its search for earnings from riskier loans and mortgage-backed securities as other banks were leaving the mortgage sector, hence ended up in a ditch. WAMU, the largest bank in American history to fail, became the face of subprime lending after creating and securitizing high-risk subpar mortgages worth hundreds of billions of dollars. Kerry Killinger, the CEO, proudly referred to his organization as the Walmart of banking, since it catered to lower and middle-class clients that other banks had abandoned. Have you ever been to WAMU to get a loan? How easy do you feel to get a loan when compared to other banks? At the time of its collapse in September 2008, WAMU had 43,000 workers, $188 billion in deposits, and 2,300 banking offices spread across 15 states, mostly in the West. On September 8, 2008, Killinger's board of directors fired the company. On September 11, 2008, shares which had reached a high of $45 in 2006 fell to $1.75. WAMU experienced a credit downgrading after reporting losses for 3 straight quarters totaling $6.1 billion. When no suitors were found, WAMU's depositors started a bank run, demanding $16.7 billion of their money back between September 16 and September 25, 2008. Despite management assurance that the company was still solvent, on September 25, 2008, the Federal Deposit Insurance Corp. Was given federal receivership over WAMU. The Federal Reserve secretly auctioned off WAMU in order to avoid further financial contagion, declaring J.P. Morgan Chase as the successor bidder on the same day. So what do you think was the reason for the collapse? Was it just due to a housing market crash, or are there hidden perimeters? Well, let's unveil. The root cause of the financial crisis in 2007 to 2008 was subprime mortgages. With the advent of this new mortgage category in the early 2000s, first-time homebuyers with less than perfect credit might purchase a home with little to no down payment. Banks and mortgages lenders took on more risks by issuing these loans, so they assessed adjustable rates of interest on subprime borrowers, which were frequently significantly higher than the rates attached to fixed-rate mortgages granted to homebuyers with superior credit. Although the principle seems straightforward, subprime mortgages really had a lot of intricate, tiny print that was rarely presented to the borrower before they were signed. Moreover, predatory lenders did, in fact, target a large number of low-income minority and elderly people who resided in areas where standard banking branches declined to open. Hence, by easily providing the loans with merely no restrictions, attracted people to take a loan from the bank. According to the Senate Subcommittee on Homeland Security and Governmental Affairs, report titled Wall Street and the Financial Crisis, Anatomy of a Financial Collapse, Killinger cited subprime and adjustable rate mortgages as the main factors behind his company's growth into the memo to WAMU's board of directors in 2004. Its signature product, the option adjustable rate mortgage, generated $42.6 billion in originations alone in 2006. WAMU then packaged these loans into derivatives and sold them to investment banks as well as to government-sponsored organizations like Fannie Mae and Freddie Mac for $115 billion. What do you think? It sounds like a scam, doesn't it? According to the report, WAMU's home loan business grew by 103% by 2007. But many of the loans that contributed to the boom were made using shoddy lending practices, such as approving mortgages for loans that borrowers couldn't actually afford, convincing people with fixed-rate mortgages to switch to adjustable-rate products, and failing to conduct adequate background checks on applicants. In one case, as the New York Times reported, the only evidence of income Washington Mutual required to approve the mortgage application from the mortgage applicant, who claimed to earn 6 figures as a mariachi singer, was a picture of them in character. Why are companies after instant gratification, even though they knew that to build great things, it would take time? Please share your thoughts in the comments. Washington Mutual rewarded its loan officers based on both the quantity and speed of loans they authorized. Customers were frequently overcharged, yet nobody appeared to care. The President's Club, which offered benefits including all expense-paid trips to Hawaii, was open to the most successful loan officers. The year his business failed, 2008, CEO Killinger earned $25 million for himself personally. So how did the public get to know the dirty game played by the bank? Since adjustable-rate mortgages were linked to market interest rates, by the summer of 2008, the effects were felt throughout the housing sector. Homeowners could no longer afford to make their new, higher monthly payments and went into default. By August 2008, 10% of U.S. homeowners had negative equity in their homes. Additionally, by June 2006, interest rates had increased 17 times in a row to 5.25%, to add more problems. Mortgage-related instruments, including credit default swaps and collateralized mortgage obligations, lost value along with the collapse of the mortgage market, which sent shockwaves across the whole financial system. The first to fail in March 2008 was Bear Stearns, one of the largest investment banks with a high exposure to toxic subprime securities, which was bailed out by the federal government for $12.9 billion. Then on September 15, 2008, Lehman Brothers, another big investment bank that really entered the mortgage origination sector, failed. This time, the federal government allowed it to fail. The financial markets were in such a state of upheaval that Washington Mutual filed for bankruptcy on September 25, 2008, and J.P. Morgan Chase bought the company shortly after. Why would J.P. Morgan buy a bank like WAMU? Did they get the bank for a better deal in the bid? Well, on September 25, 2008, J.P. Morgan Chase paid the FDIC only $1.9 billion to acquire the deposits, assets, and some liabilities of Washington Mutual. By the end of 2009, all of Washington Mutual's banking locations had been rebranded under the J.P. Morgan Chase banner, giving J.P. Morgan Chase a total of 5,400 locations in 23 states, increasing its reach into California, Florida, and Washington state. According to J.P. Morgan Chase CEO Jamie Dimon, J.P. Morgan Chase is steadfastly dedicated to maintaining a robust financial system and upholding our duty as a responsible corporate citizen. In the states and neighborhood communities where we operate, we are involved. Criminal charges were never brought against Kerry Killinger, CEO of Washington Mutual, despite the Senate subcommittee's damning report on him and threats from the Justice Department. Does this mean that high-priority people can commit any crime and still get out the bail? Can you relate this situation with any that is happening currently? Over 500 federally insured banks failed in the 7 years that followed Washington Mutual's bankruptcy, triggering a system-wide failure, according to the New York Times. It remains to be seen if SVP marks the start of a comparable epidemic. According to some analysts, the challenge SVP is confronting are highly idiosyncratic. The bank placed a special emphasis on venture capital businesses and innovation enterprises. We'll delve into that in our upcoming videos, so please stay alert. Don't forget to hit that like button and share your views on Washington Mutual's story in the comments. For those of you new here, please consider subscribing for more deep dives into the most riveting financial tales.